Now we'll talk about basically the three setups. So enough of that, general talk. That not, I know people are here for examples and sort of specifics. So the three setups that I employ are launch pads that I'll talk about with examples. The second one being the high volume edge, and the third one being relative strength. These are very basic setups, but these are sort of the foundations of how I trade. If I see these setups, I have hundreds of examples, thousands of examples on each of these, and I just execute upon them because I've built instinct and I've built, a entry tactic to deploy consistently in a position size and well so that I could be a stage 3. So the first example we'll get into right here is Coupa Software back in 2018, right around the end of 2018, early 2019. So I've deliberately not written down the specific criteria for launch pads. I feel that when you do that, a lot of traders tend to think, how do I make this into an indicator, and they really lose the point of what we're trying to teach. So the launch pad setup, and you can write this down if you want, is the 10-day, 21-day, and the 50-day being 1 to 3%. Being as close as 1 to 3% to each other, so that the price on a 10-day basis, price on a 21-day basis, and price on a 50-day basis is 1 to 3% from each other. Now, what does that tell us? That tells us that volatility is starting to dampen, right? If price is closing in a similar zone on a 10, 21, and 50-day basis, it means we've built out a really solid sideways base. And when that happens, is what we call, it's time to get directional in the markets. Either the stock is going to move up from that direction, it's going to get volatile, right? From contraction, from a contraction pattern, you get volatility to the upside or you get volatility to the downside. So we know that we're going to get a directional move with the launchpad setup. So this back in 2019 built out a launchpad where price on a 10, 21, and 50-day basis was within 1 to 3%, and the stock closes above all the key moving averages. Once we have that, we basically have our launchpad setup. That is something that you can look for consistently in the markets. That is happening at the moment as well. As we see some of the right sides coming up, we're starting to see launchpads form in many of these names. And when that happens, you could deploy an entry tactic, which could be as simple as a declining top line, the group being on fire. There are a bunch of launchpads in the same group, and now you have the group behind you. If the market gets going, then you have the market behind you. So this gray line is the S&P 500. The market is rising. The stock has formed a launchpad. Now you have an entry tactic. You deploy that, and you're functioning on a you're visualizing this because you've seen this 100, 200, 300, and 500 times in the past, and we get a good move out of that particular setup. So we'll go over another example. So this is a Chegg back in, I think, 2020 or early 2020. It was the same thing. We built out, the COVID correction. The RS line is going up. It's trying to exhibit or buck the market trend. We see all the moving averages, the 10, 21, and the 50 move in close proximity of each other. That means, it's rounded out, a fairly solid base, and it's ready to get volatile. Volatility could be to the upside or the downside in the markets, right? So, and when the stock confirms that move and closes above all the key moving averages, that's what you could execute upon. And this one I remember well because Ross had it on his top 10 report, and it ended up gapping up, and we built up enough cushion back in 2020 to get into this gap up. So that's one of the setups that you could deploy in the market. It happens every time. If a group is trying to turn from a corrective state, they will always, or for the most part, always exhibit this particular characteristic, which we call the launch pad. Now, everybody wants an indicator, right? Because they don't want to see it on the charts. They just want something to, do it for them. So if you scan this particular QR code, it will take you to our TradingView page. And this particular indicator just specifically marks out every time the 10, 21, and the 50-day are within 1 to 3% of each other. It will give you a visual clue that a launch pad might be building. So you could take this You could go back historically and study this on TradingView, and you'll see this again and again on some of the biggest winners in the market as they build out proper bases. You see volatility, contraction, you can figure out an entry tactic, and really you could collect 1,000 examples of these, build conviction, self-confidence, and then execute upon it in the markets. I could go and go through 50 other examples, but the real doing is you doing it for yourself, you looking at it and making sure that you built a visual memory so that you can succeed in the markets. Now the second one is the high volume edge. So the high volume edge is basically something has happened in the markets where the stock is gapping on, it could be the highest volume ever, so it's the highest volume the stock has ever seen. It could be the highest volume in over a year. So from one earnings cycle to the next, the stock is now exhibiting massive volume, and it qualifies as the highest volume in a year. The other one being it's the highest volume since IPO. So the stock has IPO'd and reports earnings or some news, and now the candlestick and the volume that you get that is the highest since its IPO day. So how do I come up with all of these? The way you come up with them is you go and study how do successful IPOs act, how do they double, triple, and then some, and you'll see a common thread that Facebook back in 2004 or 5 did the same thing. It was down, beaten down, just like Snapchat, Twitter back in the day when the market was favorable for those stocks. And how did they come out of that? They exhibited this very particular characteristic, which was the highest. They had the highest volume since IPO. They reported earnings. There was some favorable news or something that caught the market off guard, or some new information that came out, and it was visible accumulation on the charts. It was so exciting that the institutions could not hide it, right? So, and that is one of the edges I deploy. Now there might be, over the years, if I keep studying and the market changes and I have to look for a different type of HV edge, then you add that to your toolbox or your arsenal, and you keep developing or incrementally improving upon that over a span of years. So one thing I want to make sure, at first I would always look at highest volume ever or highest volume in a year. When I studied IPOs, I added highest volume since IPO. So a lot of these come from you have to study the markets to improve your edge in the market itself. So let's dive into an example here. So Twilio, for example. So this particular gap up back in May 2020, Twilio reported earnings. Has a massive gap up in price. The closing range on that particular day is greater than 50%. The volume that we see on that day is the highest volume in a year. That is telling me that there are institutions that are piling in to this particular name. And that is an edge, or that is something that I've seen in the past. So if it's something that I've seen in the past, the probabilities of it working in the future, if human emotions have not changed over the span of a century, then the probabilities of me extracting a profit out of this particular name are high. So we get follow-on, follow-through volume the next day. The entry tactic that we deploy, or I deploy, is what I call the HVC, which is the highest volume close. When price moves through that highest volume close and the high of the prior day, I can enter that stock, and I'm looking for instant momentum at that point so that I can build a cushion in the name right away. And then if it were to pull back in, I could sit back and look at it from a larger perspective and say that, okay, there's a lot of accumulation, and I expect whoever bought in this area to come back and scoop up some more right here so that we could keep trending higher. Now, we don't want to isolate or have, a tunnel vision that something's got the highest volume in over a year and it has to work. The market, the group, the Fed policy all come into play and allow you to, allow this stock to keep going from where it started. But it all starts from this highest volume in over a year. If you start tracking those, over a span of, 1 to 3 months, 1 to 8 months, you'll develop an instant and feel for these names and how they perform from these particular, visible accumulation on the charts. The second example is UPSD. This one's one that everybody's familiar with and one that, had massive gains in 2020. We see these 3-day, big runs, but the common thread that would tie all of these runs is the fact that this was the highest volume since IPO day. Now, if this is the highest volume since IPO day, there's something that has happened on that particular day. It might be news. It might be, it doesn't really matter. Upgrades. Someone came out and said they bought stock. This person took a position, blah, blah, blah. There's really, no, it doesn't really matter what it is, but it's exhibiting that particular edge or that characteristic that we're looking for in the markets. And then you could deploy the HVC, which is when the price goes through that highest volume close. You place your stops tightly. Maybe you take a 1 to 2% stop, or maybe, some traders take 3 to 5%. And depending on the character of the name, you adjust accordingly. And then you can extract a possible income in a very short span of time. So this is a 30% run in about 3 days, 104%, and 119. I'm not here to say that you will extract the full 119%. What I'm trying to show you is there's some potential out of that 104%. Maybe you extract 20, 30% of that move, so that you can, make progress on your account. So there's no guarantees that you'll catch the full run, but you could be part of that run so that you could continue making progress in your accounts. The third one is a recent one. I didn't want to keep them all to pre-2020 because that would be, fool's gold at that point. But this one, again, LNTH, this particular year, we saw a gap up right above the $35 mark. We saw, a good closing range, and this volume was the highest volume in a year. Now this, at this point, right about on this day, this should be on your radar. You could go study this, the story of it, why it happened. They report positive earnings, whatever the case might be, but there's a reason that you want to be tracking this, and that reason is volume. If they reported a positive story, it gapped up, and it had poor volume, the probabilities of it failing over are far higher because there's no accumulation on that chart. The fact that we see the highest volume in a year tells us that there's visible accumulation, there's institutional interest in this particular name, and that's the reason we want to be tracking it, and that's really the essence of the HB edge that we have in the markets. Then we see follow-on, follow-through volume. So the entry tactic you could deploy is the HBC area. It comes above that and the high of the prior day, and you get instant momentum out of that area where the stock is not making any excuses, right? And then this one has made about a 75% move this year. It's been a bit of a grind and choppy in the way it trades, but the real momentum started from this, gapping above this 35 spot, closing good, greater than 50% closing range, and then follow through action right away. Someone saying, I have not had enough of this stock and I want more the very next day. The third one, I'll just grab some water here. So the third one is the relative strength. This one, everybody talks about it. It's fairly easy to spot, but I want to show you guys something. How do we visualize it and how do we see it on the charts themselves? So the relative strength edge really tells us, these are strong stocks that are trying to go against the market, that are being accumulated by someone. Some force in the market is accumulating it when the market is coming back in and sort of, trashing everything else. And those are signs of accumulation. Someone has to come in and have enough interest for the stock and accumulate it. And there's only one force that could do that in the markets, and that is the institutions that really run the show on a net basis. So let's jump into an example. And this is a very classic example. There's tons of examples from 2020, but this is not isolated to 2020. You can go back to 1990s, 1980s, 1970s, and you'll see the same sort of pattern within the RS line. So we see the COVID market where market came in, and we see the RS line. So on a relative basis to the S&P 500, Amazon is performing quite well. Price was down here. We built a launch pad setup right about here. And I remember this being on Ross's top 10 as well. So we built a launch pad setup where the 10, 21, and the 50-day are in close proximity to each other. We have the relative strength lines screaming. Now we have two edges that are going at once. And what that means is we could possibly increase our position size on this name. When you have multiple edges, like we discussed back a couple slides ago, you have the RS edge, and then you have the launchpad setup. You combine those two, now you can really size up this name to perform. This is how you have a large win in the markets, and you can really see an EC spike or equity curve spike. So we see about a 50% move in a short amount of time frame. And then you also have the market. We have our follow-through days. the market goes back into an uptrend, we're above, starting to reclaim the 21-day, the 50-day, and your market edge will also come into play. That okay, maybe above you've studied the market versus the 50 DMA, like Joe Fahmy referred to yesterday, and you've built that conviction that okay, every time the market's above the 50-day, I should be sizing a little bit higher, versus if the market's below the 50-day, I should not size as much. All those forces, when they're combined together, what they really yield is how much conviction and confidence, or how much position size you're going to have in this name. And that is what will allow you to perform. And you have to be very, very, very deliberate about position sizing in the markets if you want to make this a solid source of income for us. The other example that I want to point out here is AEHR. I really like to pay attention to these younger names or younger stories. And if you go study the market, it's something that is ending up, has moved from $5 to $100 or $10 to $200. There's a common thread in those names as well. And I like to track some of these younger stocks as well, because they can double and triple very quickly in a short amount of time. So here what we have is, the gray area is sort of showing that the market is declining and there's market pressure. And then this RS line is showing that AEHR, it doesn't give a damn and is continuously moving up. And it essentially, this name went from about $5 to about $25 in the span of, less than 3 months. So what is it that started the move? The first thing is the HV edge. This was the highest volume in over a year, and this was the highest volume ever. That is our first edge that we have. This is how you get it on your radar. The other one is, you can look at is the criteria of 100% move in less than 6 weeks. That's your high tight flag type of setups, right? This is for you to execute upon these setups. You have to get them on your radar first. And if you scan for these particular characteristics, you have a chance, a very good chance, or a slight chance, better than zero, to potentially catch something that is going to go from 5 and go up to 20. So we get our HV edge, we get this on our radar. Then we see massive relative strength as the market is coming in. This stock is continuously outperforming and seeing a rise in RS. And then you could identify your entry tactics. The one that I like is the name when it gets from $5 to $10, they tend to mature a little bit more. They tend to get a little more volume. The dollar volume rises. It's on more eyes, and a lot more people see it. And then I particularly entered this name right around the 10 area and caught a double. Did I catch the entire move from 5 to 20? No, I did not. But did I catch part of the move? That's really the only goal that we have in the market. So the next one example is a recent one that I wanted to cover is FNKO. So this is a weekly chart in the markets. We see this recent drawdown in the S&P 500 this year, and this is a weekly chart of FNKO. It's built out this massive base. There are no guarantees that it's going to do this again, but it has shown the ability to go from 5 to 27 in the past. And just maybe, if it could survive the worst market conditions, it could go, bust out of this bigger base that we're seeing at the moment and sort of double from here. Now, those are, again, all probabilities. We'll have to track how it acts. If it builds, a particular spot that we could, really size up on. But this one has one of our edges, which is the relative strength line, screaming to new highs as the market conditions remain poor. The other one I want to point out is SWIR. This is very similar. The market is declining and remains under pressure, and the stock continues to rise as we see an increase in weekly average volume as well, which is this blue 20 MA line. So there's significant interest to accumulate this stock while the market moves down. So now we have one of our edges, which is the relative strength. If you go to the daily chart, this particular stock had the highest volume in over a year. That's your second edge. Now, if you combine those edges and wait for the market to be in an uptrend, the probabilities are going to align with what you're doing, and the probabilities of success are going to align, and you can size this up really, really well if and when the market gets into a solid uptrend. So that is 4 examples I had for the RS line. How are we doing for time? About in 57 minutes?
Yeah, we're at about 50 minutes now.
Okay, perfect.
Yep.
So take all of these examples, find examples, go on TradingView. They have, 100 year worth of data. You can find launch pads. You can take screenshots, print them out, build a binder full of them. You could do the same thing with the high volume edge, and you could do the same thing with relative strength. The more you visualize and deliberately do and get your hands dirty, the better it's going to be. And really, real mentorship comes from pushing people to do it on your own. It's not to create dependency and you wake up and you sign into a portal and you make sure that, I want to know his thoughts or her thoughts. It's really you have to do it yourself. You have to exhibit that self-leadership. You have to go out there and do this for yourself. So some of the closing thoughts that I have for my presentation. So one of the common things that I see traders is that X indicator or X data point doesn't work. Every indicator in the market is named after someone that made it or did well in the markets. It's not Kelter's channels or DeMark's pivots. All those people are profitable traders or did something positive that people follow. And every indicator has a point in time or a time frame it works in. So even as something as simple as the RSI, if you want to make that part of your system and you go study it, I know a trader that just looks at RSI greater than 90, runs a scan on it, has done a historical study, he wants to trade momentum in the markets, and all he does is RS greater than 90, volume greater than 100K. He's mastered that setup. So every data point works, and it has its own time frame that it works in. The second one is nothing is new in the markets if you look at it, if you study it historically, but every moment is unique. And what I'm trying to communicate with that is basically you can't have just one certain scenario and you say, okay, with this HB edge, this has to work because I've seen it work. There's always probabilities that it won't work as well. So always have scenario A and scenario B that you're operating upon. There's no guarantees in the market. Third is failure is good and use it as a weapon to improve. So failure in the markets, the more you're receptive to it, the more you're receptive to your losses, the more you look at your losses, the more that you look at your emotions, that's going to allow you to improve, and you could turn that into a weapon as well. So failure is good. Don't be down. You'll see, you're 1 to 10, you'll have moments where you will not do well, and you'll have moments that you do really well. Bottle up those moments that you do really well, and look forward to those in bad times. That's really what's going to get you, going. So the fourth is don't associate with outcomes or guarantees or things that you feel are always going to be work out for you. Try to place yourself in situations where you have the highest probability of winning. If you can only trade well if the market's above the rising 21-day and what Mike Webster can call a power trend, then do that. You want to place yourself in the highest, have the highest probability of winning in your particular time frame and situation. The next one, you're going to have bad months, weeks, and years. You're going to have times where you make no money for a span of 3, 4, 5 months. There are going to be times where you make so much money in the span of 5, 6, or 7 months that you don't know what to do with it. So you're going to have bad moments. You're going to have good moments. Focus on the bigger journey. Focus on the fact that you will continuously improve over a span of years and years in this game, and that improvement will never end. You'll never be a finished product in this game. You have to focus on, that is really the journey of it is what's worth it. So the next one, never give up. A lot of traders try this and they don't have a proper foundation with how they approach this, and they end up, saying that the market is just like a casino. You're just gambling. And if you do good, you make it. And if you don't, then so be it. So that's really the key. If you build a solid foundation, this is doable. You see people, there are 27 speakers at this conference. They have a legitimate track record. They've done it. They have edges and entry tactics that they operate upon. They repeatedly execute. It's possible. So never give up. The other one, focus on doing. A lot of what you're going to see and success will not come from watching or taking someone else's watch list or looking at someone else's opinion. It's going to come from you doing your routines, doing your market habits. Instead of consuming, internalizing and absorbing that information into how your system is going to be using it. So focus on have a binder of, with a setup and 100 charts printed out. I guarantee you'll be the subject matter expert on that particular setup, and you'll trade it better than any market participant out there. And that's really what it's about. And then the last one is, how do we extract an income? We extract an income if we repeatedly execute upon a definitive edge that we're confident in. And that is what a lot of these top triple-digit performers are doing. They're looking for the same thing again and again and again in the markets, and they're repeatedly executing it with the biggest position size that they possibly can while managing their risk to be a stage 3 trader.